Hey everyone, and welcome back. So all stocks have kind of been in a very volatile position over the past couple of weeks, but there's one group of businesses or stocks in particular that have been absolutely smashed, and that is tech stocks. The Nasdaq has been down over 5% from its highs this week, and that's compared to the broader US market, which is down less than 2%. And I think it's fair to attribute at least some of that towards this new COVID variant, which is clearly spreading some more fear into the markets about future pandemic restrictions and the potential ineffectiveness of the current vaccines. But there's also something else that is weighing significantly on investors' minds, something that was a major factor in the bursting of the 2000 tech bubble, also something that is in much worse shape today than it was back then. What I'm talking about is inflation and the Federal Reserve's monetary policy. And I know I've banged on about inflation and monetary policy and the Federal Reserve in many of my videos over the past year, but there's actually something that changed this week that is a significant change and a significant pivot. And that is that Jerome Powell, the chair of the Federal Reserve, has done a complete 180 backflip on his position on inflation and is now extremely concerned about inflation and is starting to make some significant changes to monetary policy that will influence the stock market and in particular tech businesses. So in today's video, I want to talk about where we are right now with inflation. I want to talk about how the way that we measure inflation right now is deeply flawed, and if you actually use other methods, then we're actually seeing about 14.5% inflation over the past 12 months. I also want to talk about the Federal Reserve doing a complete 180 backflip on what they think about inflation, and then I want to tie it all together and talk about how that impacts stocks and in particular tech businesses. If you do enjoy today's video, I would very much appreciate it if you take the 2 seconds to leave a like on the video and hit subscribe if you want to stay up to date with content that I post in the future. But with that said, let's jump into the video. Today's video is sponsored by SHARESIGHT. Start tracking your portfolio completely for free by using the link down in the description below. So the broader stock market and in particular high-flying speculative tech businesses over the past couple of weeks have been extremely volatile. And as I said, part of that can probably be attributable to the fears around this new COVID variant, but I would say that the vast majority of the volatility we're seeing in the market right now is driven around concerns about growing and sustained inflation and the preceding or following, or succeeding, I should say, not preceding, the succeeding monetary policy that will come from higher inflation and how that impacts tech businesses specifically. Now, a little bit later in today's video, I will be talking about how those mechanics work and how inflation leads to the tightening of monetary policy, which leads to a direct impact and direct downward pressure on tech businesses. But first, I just want to talk about what is the current state for inflation. The latest data that came in last month showed that over the past 12 months, we had 6.2% inflation. That's a 6.2% increase in the Consumer Price Index, which is a measure used by the Bureau of Labor Statistics to calculate the increase in the cost of living. And if you know absolutely nothing about inflation, all you really need to know at a very basic level is that we're looking for a range over the very long term of about 2 to 3%. That's the ideal range for inflation. So the current 6.2% rate is significantly above that, and it's actually been significantly above the 2 to 3% range for a very long time now over the past year. In fact, that 6.2% year-over-year rate represents the largest increase in inflation since 1990. Yes, 31 years ago was the last time that we saw year-over-year inflation of this level. And while that is a shocking statistic, something that should definitely perk your ears up and have you interested in wondering whether this is something that we should be deeply concerned about for our portfolios, it actually gets a little bit worse than that. Stephen Spicer, another finance creator who you should definitely be subscribed to, did a video recently covering why you actually can't even compare inflation today to 30 years ago because the way that we measure inflation has changed. So while you're seeing articles everywhere from CNBC and all of these other major news outlets saying that inflation is the worst it's been in 30 years, you can't even really make that comparison because you're talking about two numbers that were calculated using completely different metrics. And of course, you can't compare two numbers that were calculated using different metrics. That doesn't even make any sense. But what we can do is we can take the old method that started in around 1983 and apply that method to the data that we have today, and then we can get a comparable figure between previous data from 30, 40 years ago to what inflation is today. And if you do that, there's a guy who's actually been doing this, you can see that inflation is actually almost 15% today, which is absolutely crazy because if you look at that chart, then you can see that it's actually the second highest it's ever been since the 1980s. 40 years ago. And that's a period where the federal funds rate, the official cash rate, the official interest rate from the Federal Reserve was set at about 19%. So similar inflation levels using the same measurements from 1980 to today, whereas back then they had 19% interest rates. Today, we have 0. So the big question here, I think, is why is inflation measured today so much lower than it was using old metrics? Again, if we're using old metrics, it would be about 15%, but what we're actually seeing is about 6%. So why is it so much lower based on new metrics? Well, they actually made some very, very questionable changes to how they measure the consumer price index and therefore inflation over the past few years. And in Stephen Spicer's video, he breaks down in detail all of these metrics, and I highly recommend you go check out his video. I'll leave it linked down in the description below. But for example, the cost of shelter for homeowners is now calculated by using something called rental equivalence, where they call up and survey homeowners and ask them how much they could rent out their houses for if they didn't live in it. So a substantial part of inflation, which is calculating the cost of shelter, and within that cost of shelter, a substantial amount of that is people who live in homes that they own. They're using surveys to calculate what inflation is. And the latest data that they have for cost of shelter came in at 3.5%, and that is dramatically lower than if you compare it to a real metric, for example, which was rental increases. They've been over 10% over the past year. So that's a real number about the increase in the cost of shelter compared to the 3.5% that is baked in to the current CPI data. And Stephen says this in his video, and I think it's really important. What I'm saying here is not necessarily that the old method was perfect. It certainly was not, but you certainly can't compare the old method to the new method when they're two different ways of calculating it. And it also means that if you have ever thought, ever in your life, and if you've ever looked back on inflation in the 80s, looked at the chart and saw that it was, 15% inflation, if you looked back at that and thought, wow, inflation was crazy back then, I can't believe that inflation was ever that high. Well, we have the same level of inflation right now using those same metrics. So if you look back at the 80s and think, wow, that's concerning, you should be concerned today. And all of this leaves myself and other people who have been deeply concerned about inflation for some time now, it leaves us feeling as though the Federal Reserve, who do have the power to control and limit inflation, kind of leaves us feeling like they haven't really been doing their job. For starters, we were first told that year-over-year inflation would peak around early to the middle of 2021. And that made perfect sense initially, because if you go back to early to the middle of 2020, that was when the pandemic was beginning, there was restrictions in place, and there was actually very, very low inflation and even deflation for a period of time during that time. So it would make sense that when you're doing a year-over-year comparison to prices from that period, that fast forward a year in March, April, May, and June of 2021, that would be when the worst year-over-year inflation would be. And for a little while, it looked like that would be the case until inflation continued to accelerate in the last 2 months. In fact, in the last month alone, prices increased 0.9%, the highest monthly increase this year. And then we've heard this amazing word throughout the year that is transitory. Inflation is transitory. It's temporary, guys. There's supply chain issues in businesses, there's shipping problems. These things will go away. They will pass. You don't need to worry. Inflation's just naturally going to go back to normal. Well, this week, Jerome Powell, the head of the Federal Reserve, basically admitted he was completely wrong about inflation being transitory, except instead of actually admitting that he was wrong, he basically just said, we're going to retire the word. He said, it's probably a good time to retire the word and explain more clearly what we meant. So basically what Jerome Powell did was he retired a word that clearly meant that inflation was going to be very, very temporary, and then has come out and said, no, that's not what I meant. You just misunderstood me, and that's why I'm getting rid of the word. Powell also said that at the December Fed meeting, they will be discussing speeding up the tapering of money printing and bond purchasing. For those who don't understand this, up until now, really from the start of the pandemic up until now, the Federal Reserve has been printing $120 billion per month and has spent that money on buying mortgage-backed securities as well as treasury bonds from the government. And the reason why they do this is because it allows them to keep interest rates on government bonds low so that debt is cheap for governments to borrow, which has been a necessity, particularly for the US government that has spent trillions of dollars over the last year on stimulus and other kinds of things that help stimulate the economy. The problem with doing that is, of course, that by printing money, you are diluting the value of the currency and contributing to monetary inflation, adding to the inflation rate. So in an environment where we are right now, where we have record inflation or near historical record inflation, if you're using old metrics, they are realizing that they really need to speed up the reduction of that money printing. And that is what they're planning on doing at the December meeting next month. Wait, not next month, next week. I'm living in the past. I don't know why I thought it was November, but it's next week. So the plan originally was to reduce this $120 billion per month. They were going to reduce it by 15 million, or 15 billion, I should say, per month, so that by the time we get to the middle of next year, it would be finished. They're now going to be speeding that up. So apparently the two brain cells that live inside the Federal Reserve got thinking and realized, wait, we probably really should slow down the money printing since inflation is actually accelerating and not getting better. So now we get to the part of the video that I'm sure you're wanting to hear, which is how on earth does all of this affect tech stocks? What's this got to do with the tech stocks that I invest in that are not profitable, that have no revenue if you're in Rivians, if you're investing in Rivian? I don't know, I had to throw that in there. But what does this have to do with these tech businesses that have huge valuations? Well, one of two things is going to happen from here. Either first camp is that supply chain issues will fix themselves and other things will happen in the free market that mean inflation just slows down and goes back to normal by itself. That's still a possibility, even though we've been seeing accelerating inflation for quite some time now. It's entirely possible that inflation does go down naturally by itself. Or things could continue to stay at around 6%, which is not acceptable over the long term. It's about twice as high, more than two to three times as high as what it should be, or inflation continues to get worse. And if that happens, then there is going to be increasing pressure on the Federal Reserve to tighten monetary policy faster, not only to reduce their money printing, but also to change the federal funds rate from where it is right now, which is 0, and increase it, therefore increasing the cost of debt for governments, for businesses, and for individuals, slowing down the economy, cooling down the economy, and therefore cooling down inflation. But there's actually one other effect that is directly on stocks. Of course, if there are tech companies that have a lot of debt and need to renew that debt, then higher interest rates mean that it's going to cost them more and it'll be more difficult for those businesses to expand. But there's another effect. At the moment, government bonds, if you want to buy a 10-year government bond, you'll earn about 1.5%, and that is extremely low. It's historically low, but when monetary policy starts to tighten, that rate will go up. It might go to 2%, 3%, 4%, could even go to 5%. Remember, same inflation metrics from the 1980s. Back then, government bonds had ratings of above 15%. You could get a 15% return on a government bond in a similar inflation environment. So expecting that government bonds might go to 3, 4, 5% over the next 10 years is not crazy at all. And if that is the case, then for the first time in a very, very long time, bonds will offer a sound and reasonable return that is an alternative return to investing in stocks. And therefore, people will start to move money out of stocks. If you've been in my community, then you know that all of the businesses I've been analyzing over the past probably 18 months to 2 years, almost all of them have an expected return of about 6 to 8%. And that's telling me that investors right now are willing to accept about a 6 to 8% return in safe businesses. And the reason why they're willing to accept a fairly low return, 6 to 8% is fairly low historically. The reason why is because the alternative in a government bond of 1.5% is terrible. But when that government bond, or if I should say, if that government bond goes to 4 or 5%, will people be willing to risk their investment in a risky business to earn 6%? I don't think so. That return might go to 10, and that could mean a dramatic drop in a lot of stocks. And the stocks that go first and get hurt the most are going to be those high-flying speculative tech businesses. And the truth is that right now, nothing has even happened, right? Government bonds are still at 1.5%. In fact, they've been trending down a little bit over the past couple of months. Nothing has really happened yet, but investors, big investors that move most of the money around in the markets, they're getting nervous. They're starting to see that we might be at the end of one of the most insane bubbles in history. And I think it's not difficult to see that there is a massive bubble in the market. If you haven't seen my Rivian video, go watch that video. That stock is still $100 billion in value. It came off about $150 billion that it raced up to after its IPO, but a business has a $100 billion valuation with no revenue, right? If you think that that is okay in the markets, then I don't have anything to teach you here. But hope everyone got some value out of today's video. I'll be down in the comment section answering comments and questions as this video goes live. Leave a like on the video if you enjoyed it, and hit subscribe if you want to stay up to date with the content that I post in the future. But with that said, hope you guys have a great day, and I'll see you in the next video.